A distinctive quietude envelops Wall Street as Friday evening arrives. Typically, this is a silence born of relief, marking the conclusion of the trading week. The terminals fall dark, and financiers retreat to their opulent estates in the Hamptons, ready for celebratory libations. However, this particular weekend, the atmosphere of stillness carries a different weight. It mirrors the apprehension of a bomb disposal unit confronting a misfired detonation. We have just witnessed an event entirely outside the predicted sequence of occurrences. The established narrative, a pattern observed for 40 years, dictated that silver was destined to plummet on Friday. Attempts were made to suppress its value at $65 and again at $66. But the market not only held its ground, but surged forward with renewed vigor. The final recorded price on the trading screen stands at $67.14. Let that figure resonate, $67.14. We did not merely surmount a resistance level, we obliterated the ceiling. Our closing valuation represents the absolute pinnacle of the week's trading. For the individual investor, this moment signifies triumph. Yet within the risk management divisions of major bullion banks, it constitutes a dire predicament. The reason for this consternation is straightforward. The markets are closed. They are immobilized. These institutions are burdened with short positions valued in the billions, now incurring substantial unrealized losses. Furthermore, they face a 48-hour period of inactivity, unable to trade, to hedge their exposure, or to staunch the escalating financial hemorrhage. In this critical market update, we will provide an inside look into this unfolding crisis. We will illuminate the characteristics of a weakened margin call. We will dissect the implications of this specific closing price on the entire silver market's financial dynamics. And we will contemplate the immediate future, for when a market concludes the week at its zenith on a Friday, its opening on Monday is rarely placid. A palpable anxiety is building behind closed doors, and when those doors eventually open, the ensuing rush promises to be formidable. This is the chronicle of the weekend when the financial institutions lost command. To truly grasp the significance of $67, one must comprehend the customary Friday trading pattern. For decades, silver investors have endured a ritualistic Friday decline. A prosperous week would ensue, with prices climbing and optimism soaring, only to be dramatically reversed at 10 o'clock in the morning, New York time, on Friday. A colossal sell order would flood the futures market, precipitating a $2 drop and a weak close to the week. This maneuver was designed to spoil the weekend and instill a sense of defeat in those holding silver. We observed a similar attempt this very week. We witnessed the dip, the deliberate effort to anchor the price below $65. This time, however, the buyers remained steadfast. Instead of succumbing to the selling pressure near the close, buyers actively engaged the market. They purchased at the offered prices, cleared the order books, and propelled the price upward until the final trading bell. This marks a fundamental shift in market behavior, signaling the breakdown of the price suppression mechanism. The banks expended their resources, exhausting their ammunition before the market depleted its capital. A market closing at its highest point signifies a singular emotion, apprehension. Not apprehension of a market collapse, but a fear of insufficient ownership. Buyers were so eager to acquire positions that price became a secondary concern. Their priority was to be invested before the weekend commenced. They anticipated the events of the coming week and were determined not to be left behind. Now, consider the perspective of a commercial short seller, typically a bank. Imagine selling silver at $64 with a commitment to deliver at a future date. The expectation was that the price would decline, allowing for a repurchase at $60. Instead, the price has reached $67.14. This translates to a loss exceeding $3 per ounce on millions of ounces, all while the market is inactive. They are effectively imprisoned, unable to exit their positions. Throughout the weekend, they are compelled to monitor news cycles, observe the escalating geopolitical tensions, and witness the viral spread of articles concerning battery technology and solar energy shortfalls. Each news item amplifies their anxiety, knowing that when the Asian markets open on Sunday night, these same reports will influence traders globally. Should Asia's opening push the price to $68, their losses will intensify. This scenario creates a potent psychological pressure cooker. The risk managers at these banks are presently conducting rigorous stress simulations. They are posing hypothetical questions such as, what is the potential impact if silver opens at $70? Can we withstand such a scenario? If the answer is negative, they are left with a single recourse to issue market on open buy orders. They will instruct their traders to acquire assets regardless of the Sunday closing price, stating, purchase everything. This is the genesis of a gap-and-go opening. The pent-up anxiety accumulated over the weekend is unleashed with explosive force in the initial moments of trading. We are poised for one of the most dramatic market openings in history. The significance of $67.14 lies in its technical implications. It effectively purges the noise from lower trading ranges. Between $60 and $65, the market experienced considerable volatility and indecisiveness. However, above $67, the trading environment becomes remarkably clear. Examining monthly charts spanning 40 years reveals virtually no trading activity at these elevated levels. We have entered uncharted territory, a realm of pure price discovery. There are no previous investors burdened by past losses, eagerly awaiting an opportunity to sell and recoup their investments. Every individual currently holding silver is realizing a profit. Those in a profitable position are inclined to hold, anticipating further gains, rather than engage in panic selling. This factor eliminates significant overhead resistance. The sole remaining obstacles are psychological: $70, $75. These are merely round numbers in our minds, not formidable structural barriers. Therefore, $67.14 serves as the signal that we have transitioned from a zone of intense conflict to a territory of exploration. In this discovery phase, prices tend to escalate rapidly as the market seeks a new equilibrium. Given the acknowledged physical scarcity, this equilibrium point is expected to be considerably higher. However, it is imperative that I inject a note of caution amidst the palpable excitement. While I share the enthusiasm, prudence is essential. When a market experiences a vertical ascent, closing at its absolute peak, it attracts opportunistic traders. These are individuals who employ substantial leverage, driven by the conviction that the price can only increase. Such speculators pose a significant risk. They place their stop-loss orders very close to the current price. Should the bank succeed in engineering a $2 decline on Monday, all of these leveraged traders will be forcibly liquidated. Their subsequent selling will further accelerate the price drop. Consequently, while $67.14 is an overwhelmingly bullish indicator, it concurrently heightens the potential for a sharp corrective move. The steeper the ascent, the more intense the subsequent correction will be when it inevitably occurs. No asset can sustain a perpetual straight-line trajectory upward. We may witness a retest of $65. It is conceivable that Monday morning could bring a disconcerting $3 drop in silver prices. It is crucial to be psychologically prepared for such eventualities. Do not interpret $67.14 as an indication of effortless future gains. The path ahead becomes more challenging. The inherent volatility will attempt to dislodge less committed investors. Nevertheless, it is vital to distinguish between a correction and a crash. A correction is a healthy market adjustment, whereas a crash signifies a fundamental shift in the prevailing trend. Considering the documented shortages, the demand from battery manufacturers, the constraints on recycling, and the depleted vault inventories, a true crash appears improbable. Any downward movement should be viewed as the market assessing the conviction of its participants. Thus, while prices are elevated and short positions are ensnared, what precisely are the banks undertaking at this very moment? It is the weekend, and the markets are dormant, yet the lights in the financial district's towering structures remain illuminated. In the subsequent segment, we will delve into the intricacies of the weekend margin call. I will provide a detailed explanation of the processes within a prime brokerage when a client faces a significant financial shortfall. We will explore the possibility of default by smaller funds or bullion dealers, and we will discuss the phenomenon of a physical run on metal. With prices at these levels, individuals are not liquidating their silver holdings. Rather, they are eagerly acquiring it in anticipation of it reaching $100. We will examine the unfolding breakdown of the supply chain in real time. The price serves as the initial signal, while the ensuing panic is the tangible reality. Stay tuned for part 2 as we venture into the risk management chambers. If you are just joining us, allow me to reiterate the context. It is Saturday, December 20th. The financial markets are closed. The price of silver is frozen on all displays at $67.14. To the casual observer, the global financial landscape appears to be in slumber. However, within the glass edifices of Manhattan and London, a relentless activity persists. In the preceding segment, we addressed the disruption of the established trading script. Now we must delve deeper, entering the heart of the risk management operations. Every major financial institution maintains a dedicated risk department. Their primary responsibility is to safeguard the institution from catastrophic financial failure. At present, these risk managers are scrutinizing spreadsheets awash in red ink, reflecting the adverse positions held by clients who had bet against the price of silver. They are confronting the stark realization that a significant number of these clients are facing insolvency. In this installment, we will meticulously outline the operational mechanisms of a weekend margin call. We will demonstrate why, at this very moment, phone calls are being made that will necessitate billions of dollars in purchasing activity when trading resumes on Monday. We will examine the concept of a physical market freeze, where bullion dealers suspend sales due to their inability to replenish depleted inventories. And we will expose the fallacy of unallocated accounts that is currently being challenged by the world's most affluent investors. The price may be elevated, but the underlying panic is far more pronounced. Let us proceed inside. The common perception is that margin calls are instantaneous events triggered by a red alert on a computer screen that leads to immediate position closure. This holds true for retail traders. However, for institutional capital involving trades of billions, the process is more nuanced. They operate under a system of variation margin. At the conclusion of each trading day, the exchange calculates the net gains and losses. Those incurring losses are required to remit cash to the exchange to cover the discrepancy. Typically, this is a routine procedure involving transactions of a few $1,000,000. Friday, however, was far from routine. The price surge to $67.14 was abrupt and overwhelming, catching short sellers completely unprepared. Many of these funds had based their strategies on an anticipated price decline and were heavily leveraged. As the closing bell rang on Friday, they faced losses that exceeded their available cash reserves. Consequently, what transpires on Saturday morning? The prime broker initiates contact with the hedge fund manager. The conversation typically unfolds as follows. Your position is down $500 million. You have exceeded your credit limit. We require you to transfer $300 million by 8 o'clock on Monday morning. The fund manager might respond, "That is impossible. The banks are closed. I would need to liquidate other assets first." The prime broker's reply would be firm, "If the funds are not received by 8:01 a.m., we will be compelled to liquidate your position." This constitutes a forced liquidation. The fund manager's personal conviction about future silver price movements becomes irrelevant. Their underlying investment thesis holds no sway. Lacking sufficient capital, the bank assumes control of the account, and its trading algorithms are programmed with a singular directive: close the position. Given that the position is a short sale, closing it necessitates buying, irrespective of the prevailing price. The buying continues until the risk exposure is eliminated. This process is precisely what generates a price gap at the market opening on Monday. It is not driven by a surge in demand from investors who are enthusiastic about silver, but rather by banks desperately seeking to cover their clients' obligations and mitigate their own exposure. We are potentially facing a cascading series of defaults on Monday morning. If the price surges to $68, the next tier of funds will receive similar demands. It is a domino effect, and the initial domino has already been set in motion. Let us now shift our focus from Wall Street to the physical commodity market. Online bullion dealers, local coin shops, and wholesale distributors are in a state of profound shock. Imagine yourself as a coin dealer. On Friday morning, when silver prices were lower, you sold 1,000 ounces at $64, accepting payment and promising delivery. Your expectation was to contact your wholesaler on Monday and acquire those same ounces for $63. However, the price has now escalated to $67.14, and premiums are concurrently rising. To replace the ounces you just sold, you might be obligated to pay $70 per ounce. This results in a direct loss of $6 per ounce on 1,000 ounces. You're experiencing a significant depletion of capital. This phenomenon is termed replacement cost risk. In a rapidly appreciating market, liquidating inventory becomes perilous. If you sell your existing stock and the price escalates before you can replenish it, your business is at risk of failure. You have exchanged tangible assets for paper instruments that have diminished in value. So, what are dealers doing during such a critical weekend? They are largely immobilized. Visit their websites at this very moment. You will likely observe one of three scenarios. Sold out notifications dominating every product listing, indicating a hoarding of inventory. Maintenance mode screens signifying a shutdown of the site to halt further losses, or dramatically inflated premiums, perhaps reaching $80, designed to deter potential buyers. They are attempting to arrest the financial bleeding, awaiting Monday to ascertain the market's true direction. This creates a severe physical supply deficit. Public demand is surging due to the price increase, but the available supply has evaporated as sellers are hesitant to part with their stock. This confluence of factors sets the stage for an acute price squeeze. We have eager buyers with capital and sellers in a state of apprehension. The only viable method to incentivize sellers to re-enter the market is to significantly increase the bid price. A more profound transaction is occurring at the apex of the wealth hierarchy, the unallocated account sector. We have previously touched upon this, but its significance is amplified this weekend. Banks hold vast quantities of silver on behalf of their high net worth clientele. A substantial portion of this is unallocated, representing a claim on the bank's pooled silver reserves. The bank utilizes these reserves for leasing to industrial users, for hedging purposes, and for trading activities. They operate on a fractional reserve system. However, when the price reaches $67 and rumors of shortages begin to circulate, these wealthy clients experience growing unease. They begin to question the tangible existence of their silver holdings within the bank's vaults. This weekend, reports are emerging of a subtle but significant bank run, specifically targeting physical metal. Family offices are issuing instructions to convert their unallocated holdings into allocated ones. This entails specifying the exact bars, designating a segregated storage location, and requesting serial numbers. This process compels the bank to reveal its true inventory. If the silver is indeed present, the transfer proceeds. However, if it is not, perhaps having been leased to industrial concerns like Samsung or sold to international buyers, the bank is forced to immediately acquire the metal in the open market to fulfill its client's request. A bank cannot afford to inform a billionaire client that their metal is unavailable. Such an admission would likely trigger legal action and a catastrophic loss of confidence. Consequently, they discreetly procure the required bars at whatever cost is necessary, paying $68 or even $70. This internal squeeze is imperceptible to the average retail trader, yet it serves as a primary catalyst for the price's resilience. The banks are engaging in a bidding war amongst themselves to secure the metal they are contractually obligated to provide to their own clients. They are ensnared in a complex web of their own financial machinations. So, what transpires when the trading session concludes on Sunday night? We have hedge funds facing stringent margin calls. We have dealers in desperate need of replenishing their inventories. We have banks struggling to cover deficits in their unallocated accounts. Who is willing to sell? Virtually no one. Who would be inclined to sell at $67 when the prospect of reaching $100 appears imminent? The mining companies are withholding their output. The silver hoarders are not releasing their holdings. This profound imbalance, characterized by substantial forced buying juxtaposed with virtually no selling, is the direct cause of a price gap. The price effectively teleports. It might close on Friday at $67.14, only to open on Sunday at $68.50, bypassing all intermediate price points. This represents the ultimate nightmare for short sellers. They are denied the opportunity to cover their positions at $67.50 and are instead filled at $69, their losses escalating instantaneously. The occurrence of a price gap on Sunday night would serve as definitive confirmation that the weekend margin calls were indeed triggered and that the prevailing panic has permeated the entire system. It would also set the stage for a rapid ascent towards $72 by Tuesday. The banks are engaged in a panicked buying spree and the dealers are maintaining a stance of scarcity. But what of the physical metal itself? Where is it ultimately destined? In the third segment of our analysis, we will examine the physical flows of silver. We will trace the movement of this precious metal from Western markets to the East. We will investigate the arbitrage opportunities that are depleting Western inventories while simultaneously felling the vaults in Shanghai, and we will elucidate why the spot price displayed on your screen is increasingly becoming a theoretical construct. The paper market resembles a casino, whereas the physical market has transformed into a battlefield, and at this juncture, the battlefield is being systematically stripped bare. Stay tuned for part 3 as we follow the trajectory of the physical metal. If you are just tuning in, we have already covered the financial panic. We have observed banks confronting a $67 price on a Saturday, realizing their precarious position. We have examined the margin calls being issued to hedge funds. However, finance in essence is merely a series of numbers displayed on a screen. Silver, on the other hand, is a tangible entity with physical substance and presence. And at this precise moment, while the paper markets are dormant for the weekend, the physical metal is in motion. It is traversing oceans via ships, crossing continents via aircraft, and being transported in armored vehicles. And its movement is unidirectional, eastward. In this segment, we will expose the emerging physical vacuum. We will investigate why the warehouses in London and New York are being systematically emptied to satisfy the insatiable demand emanating from Shanghai. We will reveal how your current digital representation of silver holdings is rapidly becoming a spectral asset. And we will analyze the industrial entities that are completely circumventing the public trading platforms. While the banks are locked in contention over paper contracts, global powers are vying for the actual atoms of silver. Let us meticulously follow the metal. To comprehend why the West is facing a depletion of its silver reserves, one must examine the price differential between New York and Shanghai. This disparity is known as the arbitrage spread. Currently, while the New York Commodity Exchange closed at $67.14, the Shanghai Gold Exchange is trading at significantly higher levels, driven by demand from the solar energy sector and the prevailing panic surrounding battery supplies. Silver in China is commanding prices closer to $72. This represents a $5 differential, a chasm of such magnitude in the commodities market that it exerts an immense gravitational pull. As a global refiner, where would you choose to direct your silver? Would you send it to New York to be sold for $67 or to Shanghai to be sold for $72? The logical choice is Shanghai. Every available bar, regardless of its current location, is being prepared for shipment to China. This diversion is creating a severe supply shock within the Western markets. The silver that would typically replenish the vaults of the commodity exchanges is being rerouted. The metal that would normally reside in London is being withdrawn. This phenomenon, akin to a Shanghai magnet, is effectively siphoning liquidity from the Western financial system. Furthermore, with the markets closed over the weekend, this price differential is likely to widen even further before trading resumes in New York. While New York slumbers, the silver departs, and when its markets reopen, the shelves will be notably bare. There exists an additional drain on supply that will never be reflected in market charts: direct procurement. In a conventional market, corporations such as Samsung or Tesla might engage in silver futures contracts to hedge their anticipated costs. However, in a shortage environment, futures contracts become virtually useless, as one cannot manufacture a car with a paper agreement. The physical metal is required on the factory floor. Therefore, what are these industrial giants undertaking this weekend? They are engaging in off-market transactions. They are directly contacting mining companies, offering to purchase their entire output for the next 2 years at $70 per ounce, with arrangements for collection directly at the mine. This situation is profoundly detrimental to the commodity exchanges. These exchanges rely on the surplus silver from miners flowing into their vaults to back outstanding contracts. However, if corporations like Tesla acquire the silver before it even leaves the ground, that silver never reaches the exchange's ledger. It effectively vanishes from public tracking. We are witnessing a bifurcation of the market. There is the public market, where fractional amounts of silver are traded among speculators, and there is the private market, where substantial quantities are being secured by strategic industrial sectors. The public market operates under the assumption of ample silver availability. The private market, conversely, is acutely aware of its scarcity. This weekend, the private market is actively consolidating the remaining stockpiles. By Monday morning, the available inventory is projected to be even lower than it was on Friday. This leads us to a contentious but undeniable truth. The spot price is no longer a reliable indicator. For 40 years, we accepted the price discovered on the futures exchange as the genuine market price. However, that mechanism is predicated on the ease with which paper can be converted into physical metal. This fundamental assumption is now faltering. If you approach a dealer today, or even a wholesale distributor, and inquire about purchasing silver at the spot price of $67.14, you will likely be met with derision. You will be informed, "Good luck, our price is $78. The spot price has devolved into a reference point for speculative paper trading rather than a practical purchase price for tangible goods. This divergence represents a critical juncture, potentially a death knell for the current currency system. We observed a similar phenomenon in the former Soviet Union. The official price of bread was exceptionally low, yet bread was unavailable. On the black market, prices were high, but sustenance could be obtained. We are now entering an era where a permanent physical premium is becoming the norm, not a temporary surcharge. It represents the authentic price asserting itself. Therefore, when you observe the figure of $67.14, do not equate it with the value of your personal silver holdings. Consider it as a narrative designed to maintain market stability. The true value of your silver is determined by what a willing buyer is prepared to pay. And at this moment, industries in desperate need are prepared to offer significantly more than the screen indicates. Finally, let us examine the registered category within the commodity exchange vaults. This represents the silver that is legally available to fulfill contract obligations. Over recent years, this figure has steadily declined from 150 million ounces to 80 million and subsequently to 30 million ounces. With prices currently at $67, we are entering a critical zone for potential delivery defaults. The short sellers, finding themselves trapped, face two primary options: either pay billions in cash to close their positions or deliver the physical metal. The entities involved would gladly fulfill the metal delivery. This approach is economically superior to repurchasing the contract at a deficit. However, they currently lack the necessary metal. Their ability to procure it from London is hindered because Shanghai has already acquired it. Furthermore, they are unable to obtain it from the mining sources as Samsung has secured those supplies. Consequently, they are compelled to draw from their registered inventory. We observe that the accessible private holdings remain static. Meanwhile, the publicly registered holdings are dwindling. If the registered amount reaches zero, or a level sufficiently close to zero to provoke widespread alarm, the exchange will collapse. At that juncture, they will be obliged to declare force majeure and settle the obligations in cash. This weekend, market participants are engaged in calculations, specifically assessing the cover ratio. This metric quantifies the number of derivative claims outstanding for each physical ounce of metal, valued at $67. This ratio is escalating rapidly. As the price ascends, so too does the demand for physical delivery. An increased demand for delivery accelerates the depletion of the vaults. The more rapidly the vaults empty, the greater the price escalation. This constitutes a self-reinforcing cycle, ultimately leading to the disintegration of the paper-based market. Consequently, physical metal is migrating eastward. Industrial consumers are engaging in direct procurement. The prevailing spot price is an illusion. Simultaneously, financial institutions are anticipating a substantial price surge upon the market's opening on Sunday. The question arises, What course of action should be taken? How does one navigate this initial trading period? Should one capitalize on the price gap? Should one sell into strength? Or is it prudent to remain on the sidelines? In the subsequent segment, the concluding part of this weekend's analysis, I will outline the strategic approach for Monday. I will identify the precise price thresholds to monitor during the initial hour of trading. I will elucidate the psychological dynamics of a price gap, explaining why a gap upwards can evoke apprehension yet often proves lucrative. Finally, I will present the definitive conclusion regarding the trajectory indicated by this week's trading candle. The adverse scenario for the financial institutions is a tangible reality, while the opportunity is equally real for you. Remain attentive for Part 4. We are preparing for the market's commencement. We have arrived at the final segment of this weekend's market advisory. We have thoroughly examined the Friday closing price of $67.14. We have exposed the anxiety prevalent within the risk management departments of financial institutions. We have tracked the physical metal's movement towards Shanghai. Now we are left with the quietude of Saturday. However, this tranquility is misleading. It represents the calm before a significant disruption. In less than 36 hours, the Asian markets will open for the forthcoming week, and financial institutions, hedge funds, and industrial purchasers will converge on the same trading opportunity simultaneously. In this Ultimate Analysis Part 4, I will furnish you with the trading strategy for Monday. I will instruct you on how to manage an upward price gap. If silver opens at $69, your immediate inclination will be to purchase in a panic. This could prove to be a misstep. I will explain the concept of gap fill, the phenomenon where prices often retract to test the breakout level before continuing their ascent. Furthermore, I will offer my final assessment of the significance of this pivotal week. The dire situation for financial institutions has materialized. However, for you, the well-prepared investor, this is the moment you have been anticipating. Let us conclude this analysis. For silver investors, Sunday evening typically signifies a period of calm. However, this particular Sunday will be akin to the Super Bowl of financial markets. At 6 p.m. Eastern Time, the Globex futures market commences trading. This marks the initial opportunity for global participants to express their sentiment regarding the Friday closing price. Consider this scenario. We are observing for a gap and go situation. If the panic is genuine and the margin calls, which we discussed in Part 2, are indeed enforced, the opening price will be substantially higher than $67.14. It could open at $68 or perhaps $68.50. This creates a void on the price chart, an area where no trading activity has occurred. From a psychological perspective, this is impactful. It signals to all observers that the asset's value is so considerable that no one was willing to part with it at the previous price level. However, a potential pitfall exists. The liquidity is often thin during Sunday evening trading. Trading volumes are low, making it easy to influence the price. Occasionally, financial institutions may exploit this limited liquidity to engineer a fabricated price decline. They might sell a few hundred contracts to create the appearance of a weak opening, attempting to dissuade investors before the substantial trading volumes emerge on Monday morning. Therefore, adhere to this guideline for Sunday evening. Observe, but refrain from acting. Unless you are a seasoned futures trader, do not attempt to engage with the Sunday opening. The price differentials are wide and the volatility is extreme. Allow the major financial players to contend amongst themselves. You should await the stabilization of the market on Monday. Let us assume that on Monday morning, the market opens with a gap up to $69. You awaken, check your mobile device, and observe positive price movement. A surge of adrenaline, a fear of missing out, will likely ensue. Your finger may hover over the purchase button, driven by the thought, I must acquire it before it reaches $100. Pause. Markets rarely ascend indefinitely in a straight trajectory. A technical phenomenon known as filling the gap exists. Frequently, after a significant price jump, the asset's value will drift downward to the level from which it originated its ascent. This pullback serves to test the breakout point and confirm its validity. If you purchase at the panic-induced peak of $69 and subsequently the price recedes to $67 to fill the gap, you are instantaneously down $2. This can induce feelings of foolishness, prompting a panicked sale, only for the price to then climb to $70. Avoid chasing the upward momentum. If you already possess silver, savor the gains. If you intend to acquire more, await the retest. Be patient for the price to decline and touch the $67 level. If it holds firm at that point, it presents your entry opportunity. Patience is rewarded, while impulsiveness is penalized. We must now address the subsequent price target, $70. The significance of $70 lies not only in its status as a prominent round number, a psychological benchmark, but more crucially, it represents the ultimate capitulation of the bearish outlook. Below $70, skeptics can still maintain that the price movement constitutes a mere correction. They can superimpose trend lines on charts and argue for a double top formation. However, if we breach $70, the chart will appear nearly vertical. The bearish thesis will be definitively invalidated. Therefore, $70 will likely become a battleground. Financial institutions will defend this level with all their resources, implementing substantial sell orders at $69.99. Consequently, anticipate considerable volatility as we approach $70. We may reach $69.50 and experience a pullback. The price might fluctuate around this level for several days. This is a normal market behavior as the market consolidates its gains. Do not misinterpret a pause at $70 as a definitive peak. It is merely the market preparing for further upward movement, akin to refueling before breaking the sound barrier. Now I must adopt the role of devil's advocate to present the potential downside scenario, ensuring you are adequately prepared. What if this entire scenario is a ruse? What if the financial institutions have a final gambit? There exists a possibility where they exploit the low liquidity on Sunday evening to orchestrate a substantial price collapse. They could flood the market with billions of paper contracts to drive the price below $65. Their objective would be to demoralize the bullish sentiment and trigger the stop-loss orders of those who purchased at the Friday closing high. If silver experiences a decline below $65 on Monday, consider it a warning signal. It could indicate that the breakout was a false one and that further consolidation is required. In such an event, do not succumb to panic. Reiterate the fundamental drivers such as Samsung and the situation in China. A manufactured price drop in paper contracts does not negate the physical shortage. It simply presents a more advantageous entry point for accumulation. However, it is imperative to recognize that volatility operates in both directions. If you are employing leverage, trading options, or utilizing margin, such a price collapse could result in your complete financial ruin. This underscores my consistent counsel: hold physical assets. Physical silver cannot be subject to margin calls. It is stored securely in your vault, impervious to price manipulations and awaiting the eventual affirmation of its true value. Let us take one final, broader perspective. Regardless of whether we witness a gap up to $69 on Monday or a pullback to $66, the conclusion derived from this week's closing candle is irrefutable. We concluded at the week's highest points. We successfully absorbed selling pressure. We overcame prior price suppression. The prevailing trend has shifted from downward to upward. The market psychology has transitioned from fear to avarice. The flow of metal has reversed its direction, moving from west to east. You are currently holding an asset that is undergoing a simultaneous repricing by the global market. This process is inherently chaotic, potentially volatile, and can induce apprehension. However, it is also poised to be profitable. The financial institutions are enduring a challenging weekend while you should be enjoying a favorable one. You have diligently conducted your research and secured the physical metal. Now allow the market dynamics to unfold. Therefore, here is the plan for Monday. Observe the Sunday opening price. Look for evidence of a price gap. Monitor the Monday morning retest. Seek support around the $67 level. Avoid chasing the price. Allow the market to come to you. Disregard any fear, uncertainty, and doubt. The media may attempt to sow apprehension. Place your trust in the chart. The adverse scenario for the financial institutions represents an aspirational scenario for us. $67.14 is merely an interim marker. The ultimate destination lies considerably further along the path. Remain vigilant, maintain your physical holdings, and I will reconnect with you once trading has commenced.